One of the reasons why investors often avoid leverage ETFs is because of the so-called volatility decay. This belief that over time leverage ETFs decay in value, they lose value because of the volatility. Volatility decay is also often called time decay and has other names, but this volatility decay argument is not only overstated, but very misleading. And in this video, I'm going to debunk the volatility decay with some research that I did, and also a couple of papers that really show that volatility decay in most times should not be the biggest concern that you have when it comes to leverage ETFs. All right, guys, let's get straight into it. Okay, so the reality is that volatility decay, it does happen, okay? But when you are investing in an asset with positive returns over time, as long as those returns are higher than the volatility of the asset, you can use some leverage. And this leverage will increase your returns and not increase the volatility so much that it will eat up your returns. So there is an optimal level of leverage that you can use. And most people just use the 1x leverage because it's conventional. But where do you draw the line regarding the volatility decay, right? Where do you draw the line? Is it at 1.1x leverage, 1.5, 2x, 5x, 10x leverage? What's too much leverage, and when do you start having the so-called volatility decay? So in this video, I'm going to show you the research and my backtesting, and I'm going to show you the exact meaning of volatility decay. Okay, guys, I'm really tired of seeing investors missing returns and leaving gains on the table because of this lack of understanding of the volatility decay and leverage. And today I really want to demystify this. So if you have a moment where you have lots of ups and downs, and your investment doesn't go anywhere, and there is lots of volatility, you will have this decay indeed. But the thing is that Nasdaq 100, S&P 500, and many other indices, many other ETFs, they don't have this behavior, right? You expect them to go up over time. And for the stock market, the US stock market, you have over 100 years of data, which I'm going to share with you in this video. And that show that you can actually use, if you have used some leverage over the last 100 something years, you'll have much better returns because the volatility of the S&P 500, Nasdaq, and so on is not so much that will overwhelm your returns. And the first paper that I want to share with you is this paper here, Leverage for the Long Run by Markel Gade and Charles Bilello, 2016. And I'm going to scroll down here to the table that I want to share with you, which is this one. Just look at this. So this is a backtest from 1928 until 2015. And the most interesting conclusion here is that if you have leveraged the S&P 500 by 2x, you have 86 times the return of the 1x leverage, the normal exposure to the S&P 500. So the 2x leverage will deliver 86 times the returns of the S&P 500. Not 2 times, not 3 times, 86 times over this very prolonged period, of course, but it was very different, right? And the S&P 500 3x leverage would have returned 290 times the multiples of just investing with 1x leverage. And what the paper says here is that this clearly illustrates the point that there is no natural form of decay from leverage over time. The idea that leverage is only suitable for short-term trading is false when looking at how daily leverage can perform over long-term cycles. That is not to say that leverage is without risk, just that the source of risk does not come inherent from decay. But of course, there is a certain level of leverage that if you use more than 3 or 4 or 5 or 6 or 7x leverage, you will definitely have that decay. So let's jump here on the chart, and I'm going to share with you my Kelly criterion curve indicator, which I detail how to use on my Henrik Wealth Academy. You have all the details there, and I have a 5-hour long course on how to invest in this kind of ETFs. And this chart is very easy to read. Here on the y-axis you have the expected growth rates, okay, and on the axis, you have the leverage. And you have here an optimal leverage that you can use for the QQQ, which for the last 10 years would have been 374, okay? But I'm not advising you to invest with 374 leverage. But if you have invested with this level of leverage over the last 10 years, mathematically you will have the best returns possible, okay? This will be the optimal leverage. Usually we use half Kelly. Half Kelly would be close to 2x leverage, as you can see here. And with 2x leverage, you will get 75% of the returns of full Kelly, but with half of the volatility. And this will be the example of the QLD ETF that we have here, which over the last 10 years returned exactly 2,000% when compared to the QQQ 1x leverage with 556%. As you can observe, the QLD delivered much more than 2x returns over this 10-year period. It was actually close to 4 times the returns of the non-leveraged version. And this is thanks to the compounding effect of leverage ETFs. So you can see clearly by looking at this chart that there is no intrinsic decay to this kind of leverage ETFs, right? But please don't take my word for granted. I want to share with you another paper that shows very, very well that leverage ETFs would have worked not only for a period of 10 years, but for a period over 120 years. And this paper is the Alpha Generation Risk Smoothing Using Managed Volatility by Tony Cooper from 2010, which I'm sharing here on the screen. And when we scroll down, Tony Cooper basically, he backtested many, many years of market returns from 1885 until 2009. So these are basically like over 120 years of data. And over the last 120 years, you have used a 2x leverage, you'll get better returns than the just 1x leverage. And in fact, he also tested for other indices, and here more specifically for the S&P 500, as you can see, the 3x leverage will be the optimal for returns from 1950 until 2009. And remember, from 1950 to 2009, you had lots of volatility, right? You have market crashes, you have bear markets, you have tons of stuff happening, you had wars, and still the 3x leverage will deliver the optimal returns. You can also see here the optimal leverage for the Dow Jones 30 will be 2x, and this is 80 years of data, okay, 80 years of data. For NASDAQ, the optimal leverage will have been a 2x leverage, and for Russell 2000 will have been also a 2x leverage. And when you go back to the indicators, the data is indeed correct, and I can put here the SPY or VOO actually for the S&P 500, and again you can see that the optimal leverage over the last few years would have been close to 4x, but again I never use full Kelly, the full leverage that you can potentially use, but half Kelly, which in this case will be a 2x leverage, as you can see here on the indicator. The indicator shows 1.95, meaning that the 2x leverage will be safe. Now, why don't I use the full leverage? Why don't I use 3x leverage most of the time? Well, because no one knows when there is a market crash, right? And if you are investing with a 3x leverage right before a market crash or a bear market, it's not a very pleasant experience. But this is more psychological pain than actually math and statistics, because statistically speaking and mathematically speaking, using this leverage will give you the optimal returns. But of course, we are all humans, and you know, in 2022 I was already using leverage ETFs, and TQQQ declined by 80%. It's painful. In the meantime, recovered very, very handsomely, okay? Let me just share with you here the TQQQ, and you can see that 2022 was a very painful market. But even if you have invested in on the top of the 2021 market and you suffered this horrific 80% drawdown, in the meantime, it recovered extremely well. And also, most investors don't just buy at the top and sell at the bottom, right? People are sometimes like, oh my God, if you have invested in this period, you will have lost 80%. No, not really, because first, to do that, you will have to be the worst investor in the world. And second, you can use these opportunities to buy the dip, right, to dollar cost average. And dollar cost average, as I have shown in other videos, will have been the absolute best strategy to take advantage of market volatility and market downturns. So what I typically do and what I teach in my community in the Henrik Wealth Academy, you can check the link in the description of the video, and you can take a full advantage of a 7-day free trial. You can cancel anytime. In the meantime, during the free trial, you can take the stock market investing course, you can take the leverage ETF course, and you can cancel before the 7 days, okay? No questions asked. But anyway, what I do in this kind of market situation is that I'm always invested in the market. And that when there is a market decline like the 2022, I'm just dollar cost averaging and I'm increasing a little bit my leverage. That's why I don't have at the moment a 3x leverage. I have more closer to 2x leverage so that I can increase my leverage on the way down and then I deleverage on the way up, right? And if you do this, I have backtested over 100 years of data, you'll perform extremely well. One of the things that I really like the most about leverage ETFs is the compounding effect, right? And over time, these leverage ETFs really will maximize your compounding effect. If there was a leverage ETF of 4 or 5x, I'll definitely advise against it. But what we can see here on the chart is from the inception of these leverage ETFs, in this case you have the QQQ, which is 1x leverage, QLD 2x leverage, and TQQQ 3x leverage, while the QQQ returned since 2011 1,475%. The QLD, which is a 2x leverage, delivered way more than 2x during this period. It delivered 10,700%. And the TQQQ returned 35,000%. So 35,000% is definitely much more than 3x of the QQQ, right? So this compounding effect, as you can see here on the chart, can give you really asymmetric returns that no other asset in the world can give you. And by looking at the charts and looking at the math that I have shared with you, the volatility decay argument really doesn't hold up, right? Adding some leverage to your portfolio can really help your long-term returns. But again, this is a topic that we could talk about for many hours, and that's why I have created my 5-hour-long course about leverage ETFs. Check my community link, 7-day free trial. You can take the course and then cancel the trial if you don't want to stay in the community. But I still want to share it with you because the returns in my community have been really amazing. We have over 30% compound annual growth rate and an 80% win rate in our trades. So I think you should check it. Link in the description, 7-day free trial. If you want to cancel, no questions asked. All right, guys, if you enjoy this kind of content, really give it a like and subscribe so that you don't miss this useful information and information that is actually based in math and not just random opinions on the internet about leverage ETFs. All right, I'll see you soon.